O03 production, underlying framework for shorting emerging markets in early July 2026. Hello everyone, today I'll present EI comprehensive and actionable macro trading framework. Using market data from June 2026, I'll explain why I'm firmly bearish and officially shorting emerging markets in early July, following the release of key macro data from major Western countries. This entire system originated from Goldman Sachs' chief strategist. All logic is supported by historical data charts. It is all solid content, no fluff. Let's start with the origin of this macro framework. Peter Oppenheimer, Goldman Sachs' chief global equity strategist, drawing from nearly 40 years of global market research, wrote The Financial Cycle. Its core is identifying market inflections through financial cycles to capture long-term returns. This logic is simple and easy to learn. The most critical indicator of the whole framework is only one: U.S. manufacturing PMI. The reason is simple. The U.S. is the world's largest consumer market, acting as the party EI for almost every country. When party EI's purchasing intent shrinks, export-oriented emerging markets, the party B supplying the U.S., are the first to suffer. Just looking at manufacturing PMI isn't comprehensive. The U.S. service sector accounts for a huge portion of the economy. The industry standard is to overlay the services NMI and take the average to calculate the business cycle indicator. The formula is ISM-PMI plus ISM-NMI divided by 2. The following historical trend charts clearly prove that this indicator drives almost all major asset classes. First, let's look at U.S. stocks. This 10-year historical chart makes it clear. The U.S. business cycle almost perfectly leads the year-on-year changes of the S&P 500. When the cycle strengthens, U.S. stock earnings rise. When it weakens, the S&P 500 faces pressure. The correlation is very stable. Next, emerging markets. Their correlation is even stronger. They are highly dependent on U.S. external demand. As U.S. purchasing demand falls, orders, exports, and corporate profits weaken, leading to persistent capital outflows from emerging markets and index declines. In every historical PMI downturn, emerging markets have underperformed global major asset classes. This extends to commodities. Industrial metal demand is completely tied to global manufacturing sentiment. When the business cycle moves up, industrial metal prices rise. When it turns down, mining and metal sectors will be the first to enter EI bear market. This historical chart confirms this pattern. Even the currency market follows this logic. When the U.S. business cycle downturns and global demand weakens, emerging market currencies generally depreciate, and the RMB exchange rate also faces downward pressure. The logic is consistent. All data is publicly available for verification. Current PMI alone has lag. To preemptively predict turning points, there are 3 strong leading indicators, all supported by historical data. Let's break them down. First, the global central bank rate cut ratio. This indicator leads the business cycle by about 9 months. Collective rate cuts represent emerging economic pressure. 9 months later, manufacturing sentiment typically recedes. Currently, this indicator has weakened in advance, suggesting significant downward pressure on future PMI. Second, the OECD CLI Diffusion Index, which leads US PMI by about 6 months. Currently, this index continues to fall, providing an early warning signal for EI manufacturing slowdown. Third is the China Bloomberg Credit Impulse, leading US PMI by about 12 months. China is the hub of global production. Its credit contraction transmits to the global supply chain. Currently, the credit impulse continues to decline, meaning US manufacturing is unlikely to see sustained strength over the next year. This naturally brings some differing voices. EI financial blogger I highly respect, Lee Arrier, disagrees with me. His logic is based on Philly and Dallas Fed outlook indices, which are still recovering, so he predicts PMI will continue to peak. These 2 regional indices indeed have about 6 months of lead time, providing support for short-term data repair. However, I do not agree. Given that multiple medium to long-term indicators have turned downward, short-term expectations cannot change the broader downward cycle. Cycle trumps expectation. Another evidence is this EPS expectation chart. Historically, PMI and upward earnings revisions are highly synchronized. Currently, revision ratios have stalled for 4 months, reaching historical ceilings. I am certain 54 is the peak for this cycle, and the subsequent direction is downward. Many argue we are in an AI supercycle where traditional indicators fail. Let's look at history. Even in the strongest industrial dividend cycles, as long as US PMI enters EI downward phase, risk assets overall trend weaker. No matter how strong AI is, it cannot decouple from global demand. Let's look at history directly. This chart marks 4 epic industrial supercycles: 1946 to 51 automobile, 1980 to 85 energy transition, 1995 to 00 internet, and the current AI computing cycle. The conclusion is clear: risk assets trend weaker, and industrial dividends cannot reverse the downward trend of the major cycle. AI cannot sustain EI solo bull market. Finally, the technical setup. Historically, every time PMI peaks, emerging markets fall, forming parabolic peaks. Currently, monthly RSI has entered overbought territory. Prices have overextended relative to fundamentals, and momentum is exhausting. Once macro sentiment slips, we will see a significant correction. The short window is open. Downward leading indicators, historical patterns, and technical overbought conditions, these dimensions converging form my core logic for shorting emerging markets in early July 2026. I will position in EEM, EWY, and ASHR. You can witness the drop while I profit or see me take E loss. Welcome to follow. Final reminder, this content is for logic discussion only, not investment advice. Financial markets are volatile. All risks are borne by individuals. Please make independent decisions. See you next time.